Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. This is the monthly Movers and Shakers show where I dive into the top performing and the worst performing assets across the likes of the FX space, indices, and commodities to try and really highlight some of the big trends that are happening within the markets over the past month and highlight whether I think they're going to continue or whether this recent move could be extended in one direction and ultimately lead to a move in the opposite direction. Let's kick things off first and foremost with a look at the, here we go, at the FX space. So first and foremost, we can see over the course of the past month, the outperformer has been the US dollar. It's come back a little bit towards the back end of the month, leading into the new month. But certainly the fact that the US continues to struggle with inflation remains a key concern for those looking at the monetary policy implications and the possibility of interest rate cuts. We're seeing it in Europe. We've got expectations that we could see it from the Federal Reserve in September. But in my mind, I think there's a good chance that that could even be held off. It's a question mark of whether we see inflation moving back towards target. We did see the core PCE inflation metric moving towards the downside. That could lift hopes that we do see a move back down to target. But in my mind, I think there's a good chance that starts to tick higher next month. So the US dollar doing relatively well. And on the flip side, it's the Japanese yen once again underperforming. The FX intervention from the BOJ over recent months clearly not doing enough to dispel the idea that the Bank of Japan essentially is standing in the complete opposite position from the other central banks. They've raised rates by such a significant degree. The BOJ have just about managed to raise rates out of negative territory, and that's about it. Now, we're talking about the possibility of them raising rates once again in the July meeting. We're also seeing them mention the possibility of them tapering those JGBs, the bond purchases, both perceived to be monetary tightening. And so certainly we do have the possibility of that recent trend against the yen starting to come into question if we see the other banks cutting interest rates and the BOJ pointing towards a period of tightening from them. But for now, certainly markets don't really care about that. And we can see if we jump onto the charts, I'm just going to bring first and foremost the US dollar index into play. Here's the dollar index. We can see here climbing over the course of June, but that really did just reverse the moves that we saw in the prior month. May, seeing significant downside as we saw the US 10-year yield drifting lower. The hopes that we were going to see the Federal Reserve cutting interest rates soon. Now, that trajectory has still by and large remained in play. We have seen at the back end of the month a bit of an uptick in terms of the 10-year, but it's really notable that we've seen this move away, this divergence in terms of the US dollar and the 10-year. And so it's a question mark of how we're going to see them converge. Are we going to see the US dollar roll over? Or are we going to see 10-year yields start to spike? Certainly, if we see spiking inflation pressures, strong inflation pressures, likely to see that 10-year yield moving towards the upside and the US dollar likely continuing its recent trend. Now, if we're to get rid of that 10-year and just look at it on the short-term time frame, we can see that we've got a relatively clear-cut trend playing out over June. You can see here from just going to point towards all the swing lows in play here. You can see nice deep retracement, then we've got a shallow retracement, and we've got a mid, that's probably a 61.8, then a very deep retracement. So as things stand, we've come very close to breaking through that 105.374, which would negate the bullish trend seen through June, but now looking like we're going to post a potential bullish engulfing candlestick formation to potentially continue this near-term trend. But certainly out of all of the moves we've seen in June, it's interesting to note that July has kicked off with a move that already could see that uptrend negated on an intraday basis. So a breakthrough 105.374 would point towards this market potentially rolling over to potentially converge with that US 10-year yield. But until that happens, this pullback could be another retracement before the bulls come back into play, a potential bullish engulfing candlestick formation. And so there's plenty to play for on this one, but there's question marks on both sides, quite frankly, and especially that divergence with the 10-year yield. But the pullback, this sharp pullback coming so close to that key support level, really it's a question mark of do we remain above that level or do we break through that level? And that should really guide us for where we go going forward. But certainly, like I said, if we see strong economic data out of the US, which I would say that we're not necessarily seeing. We're seeing some question marks, quite frankly, out of the US, and we have got the US jobs report coming up. So that's going to be really key, with some weakness expected in terms of the payrolls. If we see weak data coming out of the US, weak inflation data, then we're likely to see the 10-year remaining depressed, and the possibility of the US dollar starting to roll over. But if we see strong economic data and strong inflation data, then you're looking at the possibility of further upside for the US dollar. And then this is the Japanese yen in index form. So essentially, this is it trading against a number of different alternate currencies rather than one in particular. And it's just for me to give you an idea. Of course, you can't trade this, but this just to give you an idea of the overall trend that you're playing with here. It's very consistent. And if we're looking on a weekly basis, it just goes down and down and down. The up weeks are few and far between. Certainly, the up months are very few and far between. And so, you're dealing with a very clear-cut trend here. But you, of course, as I've highlighted this trend so many times, you do have to be cautious because of the fact that we have got the possibility of action from the BOJ in terms of FX intervention. Now, if I'm to combine the two, I'll bring up dollar yen. And of course, if you've got the strongest currency over the past month against the weakest currency over the past month, you're looking at the strongest trend out there, and that is dollar yen. And we can see it continuing to push upwards up through the 161 resistance level. And so this is a really key market to be watching out for. It's a very reliable market as things stand. We can see here this area of consolidation here, but now pushing higher once again towards the upside. You want to see this area, this high of 161.283 broken to signal the next leg higher. But essentially, as long as we remain above the 160.260, then this bullish trend does look to remain in play for dollar yen. Next, I wanted to bring up, here's the breakdown. Sorry, this is the breakdown for, let me get rid of my head. This is the breakdown for exactly how things shaped up in terms of the FX space. The winners and the losers, and just how much that played out. Certainly, you can see to the downside also some weakness in terms of European FX off the back of the expectation that we're going to see them cutting interest rates. Now, looking ahead to the next area, this is the indices space. And so here's a breakdown in terms of the trajectory and how things played out over the course of the month. Certainly, most notably, it's the CAC really seen significant downside at the bottom there. And it's the Nifty and the NASDAQ, which essentially traded in and out at the back end of the month. The Nifty just about taking it, but certainly significant strength for Indian stocks and for US tech. Now, in terms of the breakdown, like you see there, there's not much to separate those two. We've also seen a few markets, the likes of South African markets, the remaining two major US markets, and the Nikkei and the Amsterdam 25 all in the green. But it's notable how well split this is. So it's not necessarily been a case of June saw equity markets rise. It really depends on the market you're looking at. European markets really looking to be under pressure, of course, in part because of everything that's happening in France and the potential for contagion, whereas US markets doing well. Also, the likes of the Indian index doing particularly well. So let's jump into those. First and foremost, I wanted to bring up the Nifty, and here it is. So we've been talking about this previously, right? So this was a market that we saw doing particularly well. Then we saw this massive collapse after the election, but that post-election collapse has been made up and some. We've been seeing a really consistent uptrend. So that regaining of ground took a week, I would say, maybe less than that. So here's the daily time frame. Few days it took for us to regain ground back up towards that high end, and we've been trying to sort of grind higher since then. And so you're looking at a market that has been very consistent of late. There's question marks about whether it's relatively overextended. Of course, people clearly feeling emboldened by this idea that we're going to see relative political stability. There's a view that they're going to push forward the coalition with significant infrastructure plans. There's an idea that India could do well in place of China, given the difficulties they're facing and the sort of breakdown between Western nations and Chinese in terms of trade relations, and the likes of the EU and the US putting levies on electronic vehicles. So India appears to be in a good place at the moment. The question mark here for traders is whether it's got overextended. And we can see here that we're sort of rallying up towards this ascending trend line. We haven't necessarily reached it. I would say this is just a case of following it on an intraday basis. If we break back below your near-term swing low that we've just recently established at 23985, then we could potentially come back into this retracement, this wider retracement. Then you'd be looking at, there we go, possible move in towards, the middle or deep areas of this fib zone. So, 235s up to 2375 kind of area. If we break through that support level. But until we see that level broken, this bullish trend does still remain in play. Clearly, markets feeling very confident here. And so near-term downside likely to be bought up until we see a breakdown through that key swing low. On the flip side of it, of course, we've got all of this fear around the potential for Macron's roll of the dice to backfire in style. And that's exactly how it has played out. We've now seen the first vote on Sunday. And we saw, as expected, a big win for the right wing headed up by Marine Le Pen. And essentially, you're looking at a rundown or a showdown next weekend between the far left and the far right, essentially. And so the voters that had been voting for the middle ground with President Macron are going to have to decide which one they want to side with. Now, there's a perception that we could see the far right party either side of the 289 mark, which would mean that they get an overall majority. And certainly it's going to be that which will likely dominate sentiment going forward. If they have an overall majority, they're more likely to be able to enact measures that would be perceived to be financially questionable or create greater instability. Remember, you're talking about a country that already has significant debt to deal with. But what we have seen is a pullback and some support coming into play here. And it's notable if we look back at the breakdown in terms of this index. Let me just bring up the CAC here. Let me just bring this up here. This is the breakdown in terms of the movers within the CAC. And what we can see here is that those technology names doing poorly, the bank names doing particularly poorly. And some of those names, the likes of Hermes, the likes of LVMH, that originally saw significant downside have been bought up pretty heavily. And that's where we see people differentiating, because originally we saw significant downside, but then people started realizing, hold up, this could be a really good buying opportunity for businesses that are more aligned with the global economy than the French economy. And that's why we've seen some of these names being bought up. Certainly as we move into the new month, let's get back to the chart. You can see that we're actually kicking off the month with some significant gains. And this is where we're seeing, okay, there was a victory for the far right, but at the same time, there's question marks about whether they're actually going to be able to achieve the overall majority. And so that is likely to be the new concern going forward. In terms of near-term price action, you can see that we've come into this support level, this area of support with the Fibonacci's. In actual fact, I should show you that on a daily. So we've got the wider fib where we've got the 50%, then we've got the 76.4 fib here on the nearer rally from 72.80. And so this confluence of support coming into play at the moment. We found the low here in mid-June, and now we're finding support once again. Certainly, if we break up through this near-term resistance, let me just push it up here. If we break up through this near-term resistance around about 77.29, that could give us a sort of double bottom formation and give us greater confidence of a rebound. But I would say that it's probably going to take the first week to flesh out exactly what the repercussions are, exactly what the lay of the land is from a political standpoint. And then we're likely to see probably the week after that we see some volatility as markets are trying to judge exactly how they're treating this. And then it's probably going to be a little bit clearer where we go from here. But I wouldn't necessarily say that, yeah, this is a long-term trend and it's pulled back and therefore this is a great buying opportunity, because there's still real significant volatility ahead, real uncertainty ahead. And certainly part of that is going to come down to borrowing costs, the French 10-year, the spread between the German 10-year and the French 10-year, the idea of whether we're going to see a big surge in terms of borrowing costs and therefore debt's going to go up and there's going to be greater instability, which is the kind of thing that happened with the UK with Liz Truss. So there's still some significant hurdles up ahead. But nonetheless, we have been finding some support on this confluence of the Fibonacci levels. And certainly the question mark from here on in is whether we see that majority gained or not at the forthcoming second round of the election, which takes place next weekend. Now, finally, we want to talk about the commodity space. And so what we have seen over the course of the past month has been, interestingly, a spread between the two sides of the coin when it comes to catalytic converters, because a lot of the time people talk about palladium going out of fashion because of the fact that, you know, the use of catalytic converters won't necessarily be as prominent because people are moving towards electric vehicles and away from diesel and petrol fueled vehicles. So the need for catalytic converters, which is one of the main sources of palladium, just doesn't necessarily have legs for the time being. So we've seen long-standing downside for palladium, a really nice downtrend. But some people are saying, well, you know what, platinum also could get hit. Platinum's one of those things that if palladium prices go up too much, people substitute it out for platinum when it comes to catalytic converters. It is also a precious metal. It has a tie up with the likes of silver and gold. And if we look to the next chart, you can see that we've actually seen weakness in terms of the likes of silver, and gold didn't do particularly well either. Generally, when precious metals are doing well, it's those more volatile ones like silver that do particularly well. But when precious metals are somewhat coming under a bit of pressure, it's the likes of silver that underperforms, and generally the likes of gold is more stable. And you can see exactly that here. The palladium towards the upside. We also saw strength in terms of energy markets as well. So to round things up, I'll bring up the chart for palladium first, and we can see here, let's just show you it on a long-term trajectory. This is the trend that I'm talking about, right? So, you know, we had great times over the course of 2017, 2018, those kind of years, but this trend that we've seen over the last couple of years has been pretty dour for anyone that's bullish for this market. But we have seen some stability over 2024 thus far. You can see here that by and large, the declines have seemingly been arrested for now, with that low that we set in February having remained the low essentially. Now we regained some ground over the course of February going into March. We then started to come off a bit in April. We've then been moving low at the back end of May coming into June. We're now regaining some ground. So, you know, it's an interesting one, this one. I wouldn't necessarily say that it's as clear cut at the moment because we're sort of what seems to be sort of basing out at the moment. Whether this is going to be a bottom, it's certainly too early to say. At the top end, you can see we have still got the creation of lower highs. And so that does really show you, alongside the descending or the downtrend, the fact that we still retain those descending highs does give us a more bearish slant. So if we're to look at things from a fib perspective and look at how deep these retracements have been, this is trying to clip onto everything. So let me just put it there and I will push it forward. That's one way to do it. There we go. So it looks like the 61.8 to me. Let me just get rid of the other two. So you've got a 61.8 fib retracement there. Now, where are we? So once again, we're coming into a deeper zone here. And so are we looking at a 76.4 fib at the moment? Yeah, perfectly tagged. So descending trend line and the 76.4 fib currently in play. We're rallying back towards that zone once again. So keep a close eye out for this. Certainly if we break up through this 1044 swing high, that's when it starts to look interesting as a potential bottom. But until that happens, this area that we're in at the moment is an area where we could very easily see the sellers coming back into play once again. Of course, we have got, you know, if we're looking at this near-term trend line, we have got the fact that this is a little bit higher. So you have got this sort of zone of potential trend line resistance alongside that 76.4 fib here for this current rally. But certainly if we see a move up through your near-term high, this recent peak of 1008 and then 1044, then things start looking more bullish. Until then, the fact that we've got the creation of lower highs alongside this long-standing downtrend does provide a bearish narrative for this market, despite the gains that we have been seeing of late. And then looking at platinum, we can see that, over the long term, we're seeing a market that by and large hasn't necessarily moved anywhere. You could look at this almost as a big basing pattern, quite frankly. If you're looking at the bottoms, we're sort of going lower lows and we start gradually creating higher lows. But by and large, I wouldn't necessarily say it convinces too much in either direction. I would say over the hourly time frame, things do look a lot more like a sort of bowl shape here. And so the recent pullback that we've seen, if we're seeing exactly where that came into before we started to move higher, so you can see perfectly into that 76.4 Fibonacci level, and we've started to move higher. Now, notably, if I go onto the 4-hour time frame, you can see that this downtrend appears to be over, with the fact that we've rallied up through, let's just move this, we rallied up through this 1012 resistance level and now starting to see some weakness. So we've got this sort of head and shoulders formation, double top, triple top, call it what you want. The fact of the matter is that we've now broken through the near-term low. And so it does point towards a possibility of near-term downside. The possible move in my mind would be down into a, let's just grab some of the mid to deep levels. So you're looking at this kind of zone down here, your 960, your 970 kind of area. I think there's a good chance we could continue to see a bit of weakness over the near term. But I do think if you look at this wider context, you've got this sort of bowl formation, the 76.4 Fibonacci, the rally up through your near-term resistance. That points towards near-term downside, likely being bought up, and then we start to see the bulls coming back into play. So I wouldn't be surprised to see platinum suffer over the near term, maybe the next week or so, but then potentially coming back into play with the bulls re-entering once again. So this should be a really interesting market to watch out for. I said previously, this is a market that's not going anywhere, but certainly in actual fact, if you're looking at this chart on the daily time frame, you have got a very clear-cut trend in play, and it has been relatively orderly. We haven't necessarily seen huge jolts in varying directions that make it difficult to read. It looks like a bottom here. It looks like a basing pattern. Therefore, the big deep pullback into the 76.4 fib started to be bought up. I think soon enough we'll see the bulls coming back into play once again for the likes of platinum.